topic after hedge funds. Now we do finance companies. Finance companies are a lot more popular in poorer countries and a lot more popular in developing countries because they serve high-risk borrowers, okay? And because they fill a niche which commercial banks don't fill well in developing countries like Thailand, Vietnam, and like in Cambodia. Finance companies are also getting very popular in China. So, finance company has two key characteristics. Of course, the first one is make loans, which is just the same as a commercial bank, but the second biggest one is no deposits. And the fact that it does not accept deposits makes a world of difference. Just this little difference is actually a huge difference, okay? So, what do? Number one, they do consumer lending. Now, sometimes they like to call it consumer finance, but consumer finance is still not clear. It's the same as consumer lending. Which is the same as consumer loans. Next one will be, of course, business finance, the same as business loans. And finally, they are doing a lot of mortgage finance. Mortgage finance is the same as mortgage lending, the same as mortgage loans, was not a major business of finance companies. It's been major business of mortgage banks, major business of savings banks. Down the road in the history, it became a major business of commercial banks, as commercial banks saw this as a huge market, eventually their biggest market. And when finance companies enter the mortgage market, they are the least experts. They are the ones with the least amount of capital, money, advertising and everything. Usually is an indicator that something is fundamentally wrong with the real estate market. Basically, is an indicator that there is a real estate bubble. In other words, the real estate market is overheated. Everybody's going crazy to buy a real estate. Everybody believes that real estate is the greatest investment in the whole universe. Everybody believes that real estate is a no-lose proposition. Everybody believes that real estate prices will go up, 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 and then up until infinity, right? Everybody believes that they're going to get rich from real estate. Is this kind of like Cambodia today? Well, that's surely like it's China today. Well, China last year. That's surely exactly how things are in Thailand today. I mean, well, 3 months ago, that's where I was, and people are all crazy about real estate. Okay. Well, my understanding is people were crazy like 2, 3, 4 years ago, like that here in Cambodia. But now the real estate market is a little bit cooling off, apparently. But either way, once these are, people who don't know or anything with real estate, don't have the capital, don't have anything, once they get in, to the real estate market means the real estate market is becoming overheating, okay? It's turning into a bubble, possibly a giant bubble. Okay. So if they have no deposit, the key question is, how do they finance themselves? Where do they get money from? Well, the short, simple answer is short-term loans. Yeah, they get short-term loans, usually from commercial banks, and as I'll be explaining in about 5 minutes, from their parent company. But the better, simpler, easier answer, which I've been answering, I've been lecturing for about 4 or 5 hours, spent almost 2 weeks, is from the money markets. Money markets. So they get financed on the money markets with short-term loans and short-term financial instruments. Could be commercial paper, could be whatever we studied in the money markets. They use all of these tools to finance themselves short-term. All right, let's see what else they do. Now, I already wrote it, so mentioned it a couple of times. Let me write it. They do what's called risky lending. Risky lending means lending to risky borrowers. Now, the key word, and let me see that I have it from the next page here. Oh, where'd that thing? Yes, they are a classic subprime lender. Subprime is a very important word in finance and in banking. Subprime becomes lending or lender. It's the same thing. Lending is the action, the activity, and lender is the financial institution that does it, like teaching and teacher. Okay? So, now, let's try to do this. The word prime means of high quality, of good quality, mean actually of excellent quality, top quality. So a prime borrower is a borrower that's not likely to repay. A borrower who's got a lot of assets, who's got a good solid income, who's got a good solid reliable job, who's not likely to default. So prime means in banking and finance, low risk. Subprime means high risk. Subprime has the meaning of high risk. So subprime essentially is equivalent to risky, and prime means safe, low risk. All right, so they are doing a lot of risky lending, risky business. Okay, so history. Back in the old days, finance companies began as companies that were selling on credit. And when you sell on credit, which is now extraordinarily popular in Thailand, and you'll tell me over here, you want to buy yourself a phone, iPhone 6, or now maybe 7 for $700 or $800, and a lot of people don't have $800 of cash to pay for the phone. They'll give you what is called installment credit. Sometimes one L, sometimes two L's, installment. Credit. Installment credit is usually credit given to buy a small consumer, a small consumer, possibly appliance, consumer good, any good. Refrigerator, stove, microwave, laptop, MacBook, iPhone 6, something that's going to cost more than $100, but it's going to be less than $1,000 or less than $2,000. Maybe you've always dreamed about the MacBook Pro 17-inch, right? It's going to be $2,000, but you can't just pay $2,000. Installment credit will finance it, usually for 12 months, but installment credit will be going up to 24 months maximum, and sometimes can go down to 6 months, and these are equal monthly payments. And they'll try to set up the payments to be soon after your salary. They'll typically ask you, when do you get your salary? And you may say, oh, I'll get my salary on the 1st. And they'll say, okay, you'll have your payment due by the 5th. We're going to give you 3 or 4 days to get your salary to pay us back. So installment credit is basically consumer credit for a consumer durable good. Let's write it out. Durable good. Durable good is a good, possibly consumer, it could be any other good, which can be used on a regular basis for more than a month, for more than 1 month. For example, my typical razor, which I shave myself, is not a durable good. You know, after a month or 2, I throw it away, okay? A durable good will be, I already mentioned it, computer, maybe going to last 2, 3, 4 years, phone, refrigerator, okay? TV is a very common purchase, common durable good. So all of these considered durable goods, and one of the ideas of the installment credit is that they will repossess the asset if you don't keep paying. In other words, they're going to come in your house and they're going to actually take the refrigerator from your house. They're going to take a very common good will be washing machine. They will expect that you'll keep the washing machine in your house, and if you stop paying, they'll come and do that. Sometimes they'll do installment credit for cars, but it's a little trickier. They'll give you an installment credit for a used car again, and the used car will be, again, only 12 or 24 months. And this installment credit is different from an auto loan, which I'll be explaining in a couple of minutes. So, installment credit is the original, is how finance companies came to exist. They were usually a subsidiary of a manufacturer. We call these, let me take on the next page, we call these captive finance companies. Captive finance company. Captive finance company is a finance company which is owned as a subsidiary, so as a subsidiary by a retailer or manufacturer. So, for example, we may have a computer maker, Asus or Acer, and they'll, give you, let's say, oh, our computer is like $950, and they're going to make 10 payments of $100 each, and they're going to give you installment credit to write on credit. Or iPhone, $700, they're going to say, okay, well, they're going to make us 10 payments of $70 each, or 10 monthly payments of $80. So a retailer means some kind of a, back in the US you had, what was it, Sears. You're going to have different types of retailers, J.C. Penney, that, you know, you go in there, you're going to have a J.C. Penney, and they're going to give you a special credit. It's going to be installment type credit. The manufacturer will be, let's say, a car maker, Ford, or General Motors. It's going to be for electric appliances like stoves and refrigerators, General Electric. So the manufacturer will set up his own company, its own subsidiary. It will be only in the business of lending for its own products. That's the key. In a captive company, you only lend to stimulate the sales of the manufacturer. Okay? That turned out to be, as Americans grew poorer and poorer in the 70s and 80s, they got so poor in the 80s and even 90s that they couldn't afford to buy a refrigerator. They don't have the money for a refrigerator. So when you buy a refrigerator, you have to borrow for it. Of course, they didn't have the money to buy a TV, so they had to borrow for the TV. Now, sometimes they're going to put it on the credit card, but sometimes they're going to use financing from the manufacturer, okay? So that's a very common one, okay? Finance captive company, and that's how they first started. And they give you the story of GMAC, commercial mortgage, whatever, and so on. All right, next. Very simple, very easy, common sense. 3 types of finance companies. Types. Number 1. What is this? Sales finance institutions. Sales finance institutions are exactly like captive finance companies. They specialize in the sales of a particular retailer or a particular manufacturer. The difference is that in the captive company is literally owned in a subsidiary of the parent company. That's the only difference. So every captive finance company is a sales finance company. It's a sales finance institution. So sales finance institution has the goal, the business goal of promoting the sales of a particular retailer or manufacturer by providing credit. It may be a subsidiary of manufacturer, it may be not a subsidiary. If it is a subsidiary, it's a captive company. One of the key characteristics of these, and that's very important characteristics, is speed. They are fast. You can get a loan in 15 minutes. With a bank, it's going to take a day, it's going to take a week. They don't want paperwork. In other words, the key characteristic of finance companies in general is that they do not accept deposits. Because they do not accept deposits, They are not banks. It is not a bank. If it is not a bank, means that there are no banking regulations. That's very important. Then there are no regulators, and there are no general restrictions. In other words, because you don't have to comply with the regulators, you don't have regulations, you can make a loan quick, very quick. So that's a big difference. The bank will need paperwork, show me where you work, how much is the salary, verify your salary, give me your documents. These guys are going to be quick. So the key characteristic here is that they are fast, talking about minutes, 15 minutes, and convenient. Convenient. Convenient means that when I was buying in 1998 a Ford Mustang, and I decided back then I was a poor student, that's 20 years ago, I was a student in the United States doing my PhD. When I went to Ford dealer, he said, okay, well, we can get a bank loan or we can get finance from from Ford company, okay? So basically, the guy said, okay, well, after 20 minutes of dealing on the phone with the bank, just say, screw the bank. We're going to go with Ford Finance. You're a student, you're this, you're that, whatever, you qualify for this, you qualify for that, because you're a student, you're going to graduate, whatever the story was. He arranged literally within 20 minutes from Ford Finance Company a loan to buy me the equivalent of, back then would be $15,000 to buy a brand new Ford Mustang. What was more like 13,000. That's irrelevant. What is relevant was I was there at the dealer, at the car dealer. I was just sitting there in the office, drink coffee. I gave him my basic documents and whatnot. 20 minutes later, I had the loan approved. 10 more minutes later, I had the documents signed. And an hour later, I drove off home with a brand new Ford Mustang. Okay, that's what makes America great. Okay, these things can't happen here. Not on credit. Yeah, if you pay $20,000 cash, you're going to get the Mustang, maybe. But over there is you go empty-handed and you pay no down payment. That was another major advantage for the. So basically, you're a poor student, you can get a brand new car. All right, so fast and convenient. Next, personal. Personal. Personal credit institutions. Well, as I wrote up there at the very top, if you think you can zoom in at the very top, personal credit institutions specialize in consumer finance to provide consumer loans. That's number 2. They will be doing mostly the riskier kind of like subprime, but not necessarily, okay? They will do also a little bigger, like auto loans. Now, auto loan will be typically provided by the manufacturer as part of a sales finance company. But it could be just a personal credit company, okay? They'll be financing your refrigerator, your stove, your MacBook, your phone, whatever it is, and they'll be providing loans. And last one will be business credit institutions. Again, they may be doing small business lending. They may be doing corporate lending. Corporate lending is the same as what I wrote second up there, called business finance. Okay? And now let's clarify this piece a little bit better. For corporate lending as well as consumer business lending, the first big thing which they do is leasing. Leasing is in equipment leasing. It will be a machine, could be like a printer machine. It could be a photocopier, okay? It could be a taxi car, it could be a big truck dumpster, it could be whatever machine, whatever equipment, transportation, whatever they do. Leasing means that the finance company will buy the equipment, the finance company will own the equipment, they will finance the purchase of the equipment, and then they'll give it to the business, and the business will use it. So, you're a business, you want to have it, you say that you have a taxi business and you want to get or buy 5 new taxis. You already have the drivers, you don't have the cars. You're going to go to the, we call it in this particular case, a leasing company, which is specializing in leasing. And they say, look, I want to buy 5 taxi. And they say, no problem, well, we're going to make you 3-year leases. And for each lease, you're going to be paying, let's say, $300 a month, okay? And it's very simple. Every month you pay $300 in euros. The difference between lease is the same as rent. You borrow and take to use the assets for here's the key in leasing, is for a fixed period of time and for a fixed payment. Right now, where I live down the street, I live on a lease. I don't live on a rent. Rent means you basically borrow the asset and maybe you return it in a month, maybe in a 2 month. Rent could be month to month. In a lease always has a fixed, predetermined, before beginning determined. It's a 36-month lease or 24 months lease. Right now I got a 12-month lease. So the lease is fixed in terms of payment and in terms of the period. That's what it makes. So usually it will be cars, whatever the equipment is. You can think of any kind of equipment, but printers, photocopiers will be part of it. Second will be, and that's a brand new term and a concept, factoring. Factoring means that the finance company will purchase from a producer, manufacturer, retailer, accounts receivable. Accounts receivable. So, account receivable is generated when you're, as a manufacturer, sell on credit. And the buyer will pay you within 30 days or will pay you within 60 days. So, this is a very short-term credit given by a business to its business customers. Okay? For example, the university may use here, let's say, we use a lot of printers, we use a lot of photocopiers, and we will use up a lot of, let's say, printer toner. That's the ink which is used. Well, when they buy it, they'll say, well, can you guys give us, let's say, 3, whatever, cartridges of, for ink? I mean, they may be expensive, $50 or $100, but instead of paying cash on delivery the same day, like 10 minutes later, they say, well, okay, we'll pay you next month, or we'll pay you within 2 months. And they know the university has a reputation. It's not going to cheat the customer for $300, let's say 3 cartridges, $100 each. And the seller said, no problem, pay us within 60 days. And the university says, okay, then they'll sign. That's a receivable, okay? A lot of suppliers, when they supply to a big reputable company, kind of like Lucky Supermarket, okay? When you're giving them, let's say, oranges or whatever, that might be coffee, any kind of little thing, Lucky's not going to pay its customer 10 minutes later. Sorry, not customer, supplier 10 minutes later. Supplier will come, will deliver a lot of sugar. Lucky will say, okay, we'll pay you within a month or within 10 days. Well, that will generate account receivable for the supplier. Now, for Lucky, it will generate account payable. Well, if you're a supplier and you got a whole bunch of accounts receivable, instead of waiting for 60 days to collect the cash, the factor, meaning the company, will purchase the receivable and will pay you cash today. Okay, so the account receivable may be for $100, okay, and they'll say, we'll pay you cash today, $90. And the difference will be the gain by the factor for time, we call it interest, and compensation for risk. All right, so basically, a business sells on credit. Instead of waiting for 60 days, the finance company says, oh, you got $1,000, we'll give you right away $900 cash today. And they say, okay, you can collect from him. And that's all the rest of it. So basically, they buy at a discount. Let's see what else I got. I got 5-10 more minutes. Okay, I already covered this little part. Okay. I already covered this part. Alright, now, this very tricky part, I'll try to explain again. The main, I'm switching brand new topic, assets. When you have a finance company, well, like any company, like any bank, like any business, like this university, it will have assets and liabilities. Any business has a balance sheet with assets and liabilities. The main asset of a finance company is accounts receivable. Accounts receivable. So, when they make a loan for a laptop, $1,000, and they got 10 payments to receive each $100, it will be recorded as accounts receivable. So, loans made by finance companies are accounted as accounts receivable. Whether the loan is a consumer loan, commercial loan, or business loan, it is simply an account receivable. That's the main, the most important asset. That will be most of the assets. So balance sheet accounts receivable is 70, 80, 90, 95% will be only basically account receivable. The second one will be, many companies will not do it. They'll just have real estate loans. Real estate loans, if they do them, okay? They will have not as account receivable, a very special one, leasing or leases. So when it's a lease, it is required to have a special accounting. You just put them in a separate group. Leases are separated from loans. Now, lease, technically, meaning, business-wise, a lease is exactly like a loan, but legally is very different. So, both in a loan, you gotta collect 10 payments of $100 each. In a lease, you still gotta collect the 10 payment of $100 each. But because there are major legal differences, you'll have to keep them in two separate categories. Keeps things cleaner. You may have, or sometimes will have, instead of accounts receivable, a brand new or very separate category called auto loans. Auto loan. It's loans for the purchase of a car. And it's also have to be careful because you may have an auto lease. Lease. In other words, a car may be purchased with a loan or with a lease. When the car is purchased with a lease, you actually didn't really purchase the car. It was the lessor, the finance company, who owns the car while you're using it. At the end of the lease, you may return the car. They'll just tell you, put it in front of the bank, just drive the car back. Or at the end of the lease, you may have the option to purchase the car for a particular price. So when I bought my Mustang for about $14,000 or so, at the end of the lease, I had a 5-year lease, I had the option to buy the car for about $6,500. So if I wanted, I could pay cash at the end $6,500 and I will own the car outright. If I didn't, I could return the car. And if I didn't have the $6,500, they can give me, at the end of the lease, an auto loan for, let's say, $6,000, so I can keep paying the payments. So that they're going to be collecting from me, instead of 5-year payments, they're going to be collecting 7, 8, or let's say 10 years of payment. Financial institutions want to stretch the payments so that they can be collecting more and more and more interest. Okay, let's see what else I got here. Riskier customers, subprime. Okay, well, there may be other types of lenders which operate in the world of finance companies. I got a few more minutes. One is called, well, let's write it out in English with red, loan sharks. These are very, very, very common, and a lot of them in Thailand. Back in the good, bad days in my home country in Bulgaria, you're going to have a lot of loan sharks. These are lenders. These are like shady businesses with a somewhat criminal element. They will be running an operation. They'll be giving credit and everything else. They will be, number one, having excessive, very high interest rate, like 200, 300, 400% a year interest. Well, they'll just say, we'll lend you $90, and at the end of the month, you're going to pay us $100. So it may be 7 or 8% per month, but 7% per month would easily become 100% a year. Or they'll just say, oh, we're going to lend you 90, you're going to pay us back 100, that's 11%, but 11% a month will be equal to 150% a year. So these loan sharks will have two excessive interest rates, maybe 5-10% a month or more. They'll be easily 100 to 300% a year. And the second characteristic is that they'll be using force for collection. They'll have enforced collection. These are bad guys. These are guys that you want to pay on time. These are guys who, if you don't pay today, they'll visit you tomorrow, and when they're nice, they'll only break a bone, which is a warning. If they're not nice or if they're not in the mood, they'll just kill you. Okay, these are more associated with the mafia. Okay, they're associated with gangsters. They will carry usually guns. They will be weaponized. Okay, so these people you don't deal with unless you are desperate. Okay, and unless you need the money for whatever the story might be. Okay, so these are loan sharks. Okay, and it's now in America, big business in bad neighborhoods. Okay, bad neighborhoods. When you see a lot of loan sharks, you know there's a lot of criminal activity going on. Loan sharks will be usually financing drugs and drug consumption and drug dealers and whatnot. Okay, here the big part is the criminal element, but they are part of the economy. Okay, legal or illegal, they provide a loan. They are a financial institution. And the next one will be very similar, or a very specialized payday lender. And a payday lender will provide a loan against repayment. Usually you're going to give them your card, like your ID, or you're going to give them your passport, or you're going to deposit maybe your whatever, some security. And a payday lender will give you money and you will repay when you get your salary back. So if you get paid on Friday, get your salary on Monday or Tuesday when you run out of money, you'll get a kind of like a cash advance. They're going to give you $95. And on Friday when you get paid, you're going to have to return them, let's say $100. Okay? So they charge you only 5%. 5% for 3 days. But 5% for 3 days is like 500% or 1,000% interest. Okay? So these here will be easily charging you anywhere between 200 to 1,000% annually, but they'll just lend you for a week or two. Let's say 21st, you got 9 days till the end of the month, and they'll lend you, let's say you need $200, they're going to give you $190, and you're going to give back $200, and that's for 9 days. Okay? So that will be a very typical operation, a payday lender. Now, a payday lender, when I was working in Bahrain, okay, back then, that will be 6 years ago, and had a girlfriend from Thailand, okay, her friend was she was a payday lender. She would lend to any of the other Thai girls that worked in the hair salon. They had 3 hair salons, maybe about 30 of them, okay? And she said, oh, I need so many dollars back then. And okay, when you get paid, you're going to return me. How much you need? Well, I need, let's say, 90. Okay, you're going to return me 100. And she ran a big business. Yeah, she was working at a hair salon. She was making $200 or $300 a month. Well, yeah, more like $300 a month. But from her payday lending, she'd be making way over $1,000 a month. But she had a big, sizable operation. Okay, let's see. It's time to finish. I'll complete the chapter next time. There's very